Is your bank safe? The new fear is in the air as people of the United States wants answer. 3 of the major banks in the United States have failed in a short period of time. Silicon Valley Bank, Signature Bank and Silvergate, with Silicon Valley being the largest of all with $209 billion of assets at time of failure. The question arises that how did they collapse so suddenly? Well, the short answer is that all 3 of them did not have enough cash to pay depositors. And the regulators closed the bank. The bank suffered from an old-fashioned bank run. Bank run happens. What can start as a liquidity problem can become an insolvency problem if the bank has to sell what they have for cash. And let me explain, one of the safest investments is considered to be treasury bonds. Your grandparents probably invest in it. Banks invest in them both for the same reason. They provide a stable rate of return and yield. When large sum of depositor ask for their cash back at a time when the bond market is down due to interest rates, banks need to take a hit. And that's what happened here. So how did it start? Let's take SVB as an example. It all started during the pandemic when SVB, like many other banks, were getting more deposits than they could lend out. In 2021, deposits at SVB doubled, but they couldn't lend out all the money, so they invested in ultra-safe U.S. Treasury securities and bonds. But the problem is, when interest rates increase, the value of these securities goes down. And that's what happened. SVB took a $1.8 billion hit on the sale of some of those securities, and they were unable to raise capital to offset the loss, which led to a snowball effect that caused a lot of depositors to withdraw their money. But are the deposits safe now? From a practical perspective, the FDIC is now running the bank, and it's typical for the FDIC to shut a bank down on a Friday and have it reopen the following Monday. In this case, the FDIC has already announced that the bank will reopen on March 13th as the Deposit Insurance National Bank of Santa Clara. For depositors with $250,000 or less in cash at SVB, the FDIC said that customers will have access to all of their money when the bank reopens. However, those with uninsured deposits may or may not receive back the rest of their money. This is all pretty intense stuff. But what does this mean for the banking industry as a whole? Should we be worried about more bank failures? It's unlikely that SVB's failure will spill over to other banks. SVB's collapse does highlight the risk that many banks have in their investment portfolios, and if interest rates continue to rise, the value of the investment portfolios of banks across the U.S. will continue to go down. However, most banks currently have enough capital to absorb these losses, so the banking system is still sound.